The problem with altcoins making a move, that happens when when investors are willing to take on the most amount of risks. If you ranked all the risk assets, it would be like, obviously bonds are the safest, kind of the thought process here. Gold is kind of the safest as well. Then you get to stocks, which are small caps are the riskiest, then mid caps, then large caps, then mega caps. Then you get into crypto, okay, Bitcoin. Now Bitcoin has run. And the point being is that what we're seeing here is that one asset runs one day, then the next riskiest one runs the next day, then the next riskiest runs the next day, et cetera, et cetera, et cetera. And eventually when you get to the riskiest runners, the market oftentimes has run out of juice because everything has run, and now investors are so into risk that there's nowhere else to go, and that's when you see the market start coming in.
When altcoins start lighting up the board, it's easy to get caught up in the frenzy, but seasoned investors know this could be the market's last gasp before a pullback. Crypto moves in waves, with money flowing from the safest assets to the riskiest in a predictable pattern. Bitcoin leads the charge, followed by large-cap altcoins, then mid-caps, and finally, the wildest small-cap tokens. By the time speculative coins surge, the rally may already be on its last legs. Gareth Soloway highlights this risk ladder phenomenon, drawing parallels to traditional markets where bonds and gold anchor the conservative end, while small-cap stocks and altcoins represent the ultimate gamble. He warns that when investors pile into the riskiest assets back-to-back, it often signals exhaustion, like a fireworks final burst before fizzling out. Once every tier has had its moment, there's nowhere left for the momentum to go, and the market typically turns. For crypto traders, recognizing this pattern isn't just insightful, it could be the difference between riding the wave and getting wiped out when the tide reverses. The lesson? When altcoins go vertical, it might be time to tread carefully. Stick around as we bring you more clips from Gareth Soloway's explosive Bitcoin analysis. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Crypto was dead for a long time, especially like things like Ethereum. Ethereum, by the way, has woken up tremendously. But even Bitcoin, you can see Bitcoin for the longest time was just going like this, basically 2 to 3 weeks of just sideways chop. It obviously took off to the upside. Now, altcoins have followed suit with some big, big gains. Now, for altcoin investors, that's great to see. In fact, we had Ethereum, we had Near Protocol and Smart Money Crypto, so that was nice. We got some good gains out of that. Even though Bitcoin's had a great move up here, and it could continue in the near term, it's a warning sign for me that altcoins are starting to pump significantly. Like I saw Pepe, a lot of these crap coins, these meme coins, they're really starting to run. That's not a healthy sign for the market. In fact, it might be telling us that we're getting close to the end of this bull run, not only in crypto, but more so in the stock market. And that's more the signal for the stock market that I want to draw your attention to. Okay, so as we go up, the big level, obviously, you have this high and this high. There's a trend line here that's right around 109. And if we did go up and pierce the all-time high, where would the significant line be? This high and this high. This trend line up here extends all the way back to 2017 bull market high and then the 2021 highs. It connects right through this high, right through this high. And likewise, if we were to trade up, that would be a major, major resistance level at 113 on Bitcoin. All right. And again, remember, I'm a short-term trader. Doesn't mean where Bitcoin's going to be in 6 months or a year or 5 years from now. Probably a lot higher, frankly, in 5 years from now. But again, as a short-term trader, I'm looking for where can I take advantage of a pullback and then go long at support and short it at resistance, go long at support, and just play the back and forth on the chart. So keep an eye on this on Bitcoin, but also keep an eye on risk assets as they've all really started to run. We've even seen a lot of like the Rigettis, the quantum stocks that, again, were hallmarks of the stock market when we were at all-time highs in December, in early January. Those are all starting to run as well. And again, to me, that's the beginning of a caution sign in the markets, in investing. Okay, it's not a red alert like run away, but just be aware here. We know the S&P's at a key level, and we know that we're getting these other signals. Just be aware, and that's what I want to pass along to you guys. So if we go to the S&P daily chart, we're looking at a major level, and the markets are battling here. You have the bulls versus the bears. Can the bulls push the market above this key level? Now, if you go back a month ago, I was already telling you guys this was going to be the major stand for the bulls versus the bears. This was my target to the upside on a bounce. Now, again, why? Well, number one, this was a major gap fill, right? So if we look at this, again, a gap fill right there. So this was basically Liberation Day and then the gap down and the massive sell-off that followed. So it makes sense that now that we've recovered to that level, you're seeing this sideways chop, which is essentially, what is sideways chop? It's where you have sellers, right, coming into the woodwork amidst buyers. And they're basically head-to-head and against each other, but not making headway either way, right? Essentially, they're equaling each other out. And so that's what's going on right now. And the question is, who's going to blink first? Are we going to see the bulls break us to the upside like this, or are we going to see essentially the bears winning out and taking the market back down? And again, that's something I'll be watching very keenly next week based on this line right here. Now, this line is also significant because it's also the 618 Fibonacci. Right in here is the 618% fib. And again, we know from psychology that Fibonacci levels have a tendency to be major levels in the market. So the fact is, this gap fill and the fib right here, they're all right in the same area, and that's adding additional resistance to the potential bullish breakout. All right, so again, we're going to be watching that. Now, let's just talk a little bit here. What if the markets do break up? Where do they go? The first level of resistance on the S&P is going to be right here. What's interesting about that, you can't see it on my chart, but there's a key level that extends further out. But basically, you'd have a little bit of a level around 5,800. So if we can break this 5,675 area, which is currently where we're trading and we're hammering on, the level on the S&P to watch would be 5,800. That would be the next big stand where the bears would again attack and try to push the markets back down. Now, what if we start to see the bears winning out? What if we start to see the markets rolling over significantly? How far down do we go? The first level you're going to watch on the downside is this low, which was this low. Put a trend line right through, and it basically takes you to approximately 5,100 on the S&P. If that breaks, and by the way, why is that level significant? All right, that level is significant here. Let's take a look. Because we had our flagpole here, right? So here's your flagpole. And when I say flagpole, I'm going to lead it into a bull flag in this scenario, right? So your flagpole up, right? Here's your flagpole. And then essentially this was the sideways chop, essentially a bull flag that led to this move up. So essentially we had this low to these highs here, chopping inside of here, and then we broke out above it, which allowed us to get up into this level, right? So essentially we had bullish consolidation. So likewise, what we know is former support becomes resistance and resistance becomes support. But in this case, if we break down significantly, this former level will be a stand for the bulls at 5,100, meaning that again, if we trade down here, the bulls will try to support this level, okay? Now, if it breaks, what happens? We test the recent lows here at around 4,800. All right, so again, notice how I'm giving you all the scenarios. And you might say, well, why is he giving us all the scenarios? Because as a technical trader, every move in the chart is significant. It's like a chess move where it changes the probable outcome of the next move in the markets. And as a trader, I need to know every change in probability because that's going to depend on where I allocate my capital, long or short more or long more. How are we going to do this? And so again, watching the levels is keen to understanding the likely next move in the market, which means that I can make extra money and people that follow me obviously can do the same. If we go to the QQQ, we can see the Qs, which is the Nasdaq 100. This is made up mainly of about 50% of the Qs, by the way, is like the Magnificent Seven because they're so mega sized in their trillion-dollar nature. But look at where we are. Same general vicinity, a key level on the chart. Now, again, like I showed you with the S&P, if we do a Fibonacci retrace, look at, here's your 618 right here. So you can see that this is, again, just like the S&P, it is a stand of bears versus the bulls. There's a battle going on here. The sellers are coming in, they're pounding it down. The buyers are trying to push it up. Does it break out or does it break down? If we break out, where is our next resistance on the QQQ? See this pivot low, how the market went like this, then it came down, then it went up like that, kind of an M formation in technical analysis. But what that does is it gives us a midpoint here to understand where the next resistance would be, which is actually right at 500 on the QQQ. That's if we break to the upside. If we break to the downside, the green flagpole would be support number 1 at 466, followed by this pivot at 432, and then double bottom. US 10-year. So we are on the verge of a breakout. Now, you may look at this chart and say, wow, that looks like a breakout to me. Why is he saying on the verge? I'm saying on the verge because it hasn't confirmed. Okay, yes, it's closed above. That is not confirmation. Like I've said to you guys many times, the institutions will play games with you, making you jump one way when they just want to reverse it the other way. Once you confirm, the odds of a breakout not being a true breakout diminish significantly. Here, today's candle does not confirm yesterday's breakout. Gotta wait and see next week what happens.
Just months ago, crypto was left for dead, Bitcoin stuck in a frustrating sideways grind, Ethereum barely flickering, and altcoins all but forgotten. But fast forward to today, and the market has flipped dramatically. Bitcoin has roared back to life, Ethereum has awakened with a vengeance, and even speculative altcoins, from solid projects like Near Protocol to meme-driven nonsense like Pepe, are posting eye-popping gains. While this surge is exciting for traders cashing in, it might also be flashing a warning sign. When the riskiest assets start pumping, it often means the rally is nearing exhaustion. Gareth Soloway, a seasoned market strategist, points out that this pattern isn't unique to crypto, it's a classic risk ladder. Safe haven assets like gold and bonds move first, followed by blue chip stocks, then small caps, and finally, the wildest crypto plays. When meme coins and low-quality altcoins start flying, it's often a signal that the market is running out of buyers. And if history holds, that could mean trouble not just for crypto, but for stocks as well. While Soloway's risk ladder reveals crucial market signals, Mark Yusko sees a bigger picture. Bitcoin isn't just another asset. It's rewriting the rules of money itself. From Venetian bankers to decentralized ledgers, we're witnessing finance's next evolution. Let's watch clips from his interview.
So let's take gold. So I have a buddy in the business, the hedge fund business, Kyle Bass. People probably heard about him. He bashes on China all the time. And if you go to Kyle's office, underneath his desk, he has a safe and he has a giant gold coin from Australia. It's 26 kilograms. And he picks that thing up and he says, hey, you want to see the gold. Now look, let's say I was Kyle and I reached down here under my desk and I pulled out this gold bar and I want to send you half. Well, as strong as I think I am, I couldn't break that gold bar in half. Even if I couldn't stuff it in the computer and send it to you. But with a couple taps of a keystroke, I can send you Bitcoin instantaneously, anywhere in the world for free. That transfer of value is more efficient. So what the internet did to information, the TruthNet does to value. And this actually all goes back to your homeland, to Italy. Italy really is the center of the universe. And right now with the Pope passing, it's the center of the universe again. Everybody's watching. But it really was the center of the universe in the 11 and 1200s because the Venetian merchants and the original bankers had control of trade and control of money. And the Venetian, I think it was called the Florent, was the primary mode of trade in terms of currency. And then these Portuguese monks, I love this part, like literally Portuguese monks, the Knights Templar, believe it or not, they're real, had this thing where they would send knights out on these quests, and some of them didn't come back. And so their gold was parked at the abbey, and they're like, you know what? We could lend that gold out, charge interest on it, and so they started this idea of banking. And so the Medicis said, we like that idea. So we're going to steal, because good artists borrow, great artists steal, right? We're going to steal that idea. And if you think about it, in the old days, if I wanted to lend you money, I would lend you money. I would write down on my papyrus tablet, because I'm super old, okay, that Mauricio owes me $100. and you come back a year later to pay me 110, and I'm a bad guy, so I've scratched out the 100 and I say 200, and you go to pay me 110 and I say, oh, I'm sorry, you owe me 220. You're like, but I only borrowed 100. Yeah, but there's only one ledger. You trusted me. I'm not trustworthy. So you're out of luck. So the Medicis came along and said, well, all right, Mauricio's going to do one, Mark's going to do one, different ledgers, and we, the benevolent Medicis, for a small fee, will make sure the ledgers match. Dual entry accounting. Awesome. Okay, great. So you go off to work to make the 110, you come back to pay me. In the interim, I go to see the Medicis. I'm like, guys, I'm going to change my number to 200, and I'm going to give you half. Sounds like a good deal. So you come back, you go to pay me 110, I say 220. You say, hey, Medicis. And they're like, oh, Rachel, you must have written the number down wrong. We're sorry. You owe 220. So we need a third person to monitor the arbiter. Well, but then what if they pay that person? So then we need another person and another person. It starts to look like a chain of blocks, a blockchain. That's why Scott Stornetta, who's actually an advisor to us, coined the term in 1991. He said the only way to make a system sound is to have a third ledger, and then a fourth, and then a fifth, and then a sixth that gives you truth. So now if I want to send you value, I have a Bitcoin. The world, the network of thousands and thousands of nodes, 51% say, yep, Mark has a Bitcoin. He wants to send it to Mauricio. Okay, great. He sent it. Mauricio's got it. Now it's his. Once that occurs, I can't say, well, I had two because I only had one. I can't say I didn't give it to you because the network approves it. So we went from trust, we had to trust the banks and the intermediaries to truth. And that was the biggest aha moment of all. So here we are today. Now we're moving from Web 1 to Web 2 to Web 3. Okay, well, let's map that out. Maybe Bitcoin is like TCP/IP, the base layer. Okay, that works. We got Filecoin, which is kind of like FTP, kind of, maybe. And we got Ethereum, that's kind of like www. It's kind of like a toolkit that you can use to build other things. Okay. But then it breaks down. We don't really have the equivalent of SMTP. Is it Cosmos? Is it Solana? Is it Polkadot? Doesn't really map. And then HTTPS doesn't. So that one doesn't really map. Okay, well, another mental model is, well, what if we have a new regime where we have all these L1s, Bitcoin, Ethereum, Solana, and then we're going to use bridges to go across. That's where all the problems are. If you look at all the hacks and all the exploits, it's always in the bridge. Well, Chainlink says, oh, no, we fixed that. We got this great bridge. It's going to be awesome. And you can do interoperability and maybe. And okay, I mean, I could see that as a paradigm. But I'm starting to shift back to what I call the Lord of the Rings view. One chain to rule all chains. Bitcoin is basically all we need. And it serves as the L0 and L1 because it's the central repository. Look, you can make a lot of money as an investor if you're willing to go through the pain early. In fact, that's why it's my pinned tweet. The greatest wealth comes from investing in innovation. Now, in order to do that, you have to invest in something that you believe in before others even understand it. So you'll be mocked and ridiculed for your non-consensus action. It's totally worth it. And I say a couple things about investing. You can judge the quality of an idea by the quality and vehemence of its detractors, right? The fact that people like Warren Buffett and Jamie Dimon and anyone else is smart and powerful hate Bitcoin probably means it's a pretty good idea. Like if they didn't care about it, it's probably not a very interesting idea. And the second thing is when you make an investment and you feel really good about it, right? You feel really excited, you're probably going to lose money. And if you're feeling ecstatic, you're probably going to lose a lot of money. because it's already in the price and you're just going with the flow and you're doing what everyone else does. When you make an investment and you feel a little sick to your stomach, you're probably going to make money. If you feel really bad and people are telling you you're an idiot, you're probably going to make a lot of money.
Picture this. A hedge fund manager reaches under his desk and pulls out a massive 26-kilogram gold coin, a tangible store of value, but utterly impractical to divide or send across the world. Now contrast that with Bitcoin. With a few keystrokes, you can transfer value instantly, globally, for pennies. This is the seismic shift we're witnessing. What the internet did for information, Bitcoin is doing for money. The irony? This revolution traces back to medieval Italy. Venetian merchants and Florentine bankers pioneered modern finance, while the Knights Templar accidentally invented banking by lending out idle gold. But these systems had a fatal flaw: trust. Ledgers could be manipulated, numbers fudged, and debts inflated. The Medici solved this with double-entry bookkeeping, but even that relied on trusting centralized intermediaries. Bitcoin comes in as the ultimate solution to this centuries-old problem. As Scott Stornetta, who first conceptualized blockchain in 1991, realized, true financial integrity requires decentralized verification. Bitcoin's network of nodes creates an immutable truth machine where transactions are transparent, irreversible, and trustless. No more Medici manipulations, just cryptographic certainty. Today's crypto landscape resembles the early internet, a patchwork of protocols, Bitcoin as TCP/IP, Ethereum as HTTP, with messy bridges that hackers exploit. But here's the contrarian view. Maybe we don't need this complexity. Maybe, like the One Ring in Tolkien's saga, one chain, Bitcoin, could rule them all, serving as both L0 and L1 for a streamlined financial future. True wealth isn't made by following the crowd, it's built by enduring ridicule for believing in innovation before others see its potential. The louder the critics, the stronger the signal you're onto something revolutionary. Remember, if an investment feels comfortable, you're probably too late. The stomach-churning, "Am I crazy?" bets, when gold bugs scoff and bankers sneer, are where fortunes are truly made. The lesson is this: while gold gathers dust under desks, Bitcoin is rewriting the rules of value itself, just as the Medici and Templars once did. But the difference is, this time, the power isn't in vaults or ledgers, but in code that can't be corrupted. That's the real revolution. As we wrap up, do you think Soloway is right about an impending market pullback? Also, do you believe in Yusko's vision of Bitcoin as the future of money push? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.